So, and that's always the big question. We do a lot of stress testing in our portfolios to try and understand if interest rates move, what impact will it have on cap rates. I think, I believe that interest rates will be carefully managed because I think all of the sovereign nations who are in control of their monetary and fiscal policies are going to work hard to have any increase in interest rates occur in a moderate way so people can keep pace. So under that premise, I think your valuations will hold reasonably well. You might get a little bit of downside valuation in some of the lower class assets or in some of the assets that are in challenge markets like Alberta. But as long as that cost of money doesn't move too dramatically, there's room, I think, in the lending space to allow a little bit more compression in the spreads over bonds and keep cap rates relatively stable for the time being. If we were to get a big spike, yes, you'll get capital losses, but I guess the happy coincidence in that is you end up with higher income yields after the fact. So,
my overall comment about rates, and I talked about the abundant availability of capital, both debt and equity, the quantitative easing, and the effect that it's had on both short and long-term rates. I expect that the rate environment will remain fairly stable during the course of this year, and as a result, based upon my comments about values, with a stable interest rate environment, I think you're going to see a stable cap rate environment overall. And again, by market, because not all markets are created alike, you're going to see some upwards and downward pressure on cap rates, but that's going to be more a function of kind of the specific asset and or submarket or broader market than it is going to be affected by kind of the more secular trends that may exist for interest rates. For us, the real challenge in this very capital flush, low interest rate environment is finding the right opportunities and properly calibrating the risks and pricing them accordingly and getting rewarded for the risks that we as a lender take. On behalf of our investors, our job is to prudently assess risk, price it so that it is supported by the underlying dynamics of the project being financed, with, at the end of the day, it producing the yield and the return of capital that is incumbent upon us as fiduciaries for our clients.
Most of our business is focused on core real estate or major market real estate in the 6 or 8 major markets in Canada. So for those markets, we don't expect a huge shift in pricing. For pension fund capital, they have the privilege of, if they choose to, doing their transactions entirely in cash. So we don't have the same need for debt as some of our competitors have. So in a perfect situation, perhaps that difficult debt situation is actually an opportunity for our business and for pension funds. But again, I expect the debt to be readily available, more than enough in 2017. So I don't think you're going to see it affect pricing or cap rates significantly. Maybe small shifts, but not a significant shift.
Well, right now the spread between the 10-year bond, really the risk-free, and the average cap rate's great enough that it can withstand 10 to 25 basis points. It could withstand 25 to probably 50 basis points. So I don't think you're going to see movement in cap rates due to the debt market moving forward and accelerating. I think this is something that slowly but surely, maybe next year it's an even better question to ask me. But right now, I don't think it changes anything because I think real estate, back to the first question, is probably going to get more expensive, not less, in the coming year.